George, thank you. You covered so much there. I know for a lot of people, it may go over their heads a little bit, but just it's clear that you believe there's a recession coming, and it's going to look different. It could more look like a 1970s event rather than just simply some sort of crash. So let's start with George. Welcome, George. And why would you say most people are unprepared for inflation, and why is it something the mainstream is starting to talk about more now?
Well, I think the main thing they're unprepared for is asset price deflation and consumer price inflation. And if we look at the 1970s, that's a great example. From 72 to 74, the stock market actually went down by 50% in nominal terms. So people have this idea that if we're in an inflationary environment, that means that asset prices, such as especially risk assets, have to go up. And that isn't necessarily true. Another thing that I would point their attention to is the yield curve. If you look at the 2s and the 10s, and I'm sure this is something that Rick's paying a lot of attention to right now, the yield curve is actually flattening. And if you look at the Euro-dollar futures curve out to past 2024, it's inverted. And so then if we take Powell at his word that he's going to raise interest rates, let's say 3 to 4 times, if we just think that, okay, Fed funds is going to, let's just say 1%. And then right now, I know the 10-year was down, so I believe it's at 1.75. And if we look back at the last time the yield curve inverted, which was 2019, there was about a 60 basis point spread between the 1 year and the 2 year and Fed funds, roughly, right? So if Fed funds goes to 1%, then we can assume that the 1 year, the 2 year, which is usually the benchmark that they use to juxtapose against the 10 year to see if the curve is inverted, which is a 100% sign that we're going to have a recession. So the 1 year, 2 year, let's say that gets up to 1.6, right? Well, the 10 year right now is at 1.75. So that means that the 10 year would just have to go down another 20 basis points, and we would have another inverted yield curve, which means that there's a extremely high probability that we go into another recession. Now, I don't think people are prepared for an inflationary recession like we had in the 1970s. And again, this is where asset prices go down significantly. We've seen, go back to November 3rd. That's when the Fed announced tapering, which, just to remind all your viewers, that's just when they're doing less QE, right? That's when they're taking their QE program down to zero. They announced it November 3rd, and they started implementing November right around the 15th. So they were doing 120 billion a month in QE, and they dropped that down to, I think, 105, and then they've taken it down since then. But the market is down, I would say, 10 or 15% since they announced the tapering program. Now, they haven't even gotten to the interest rate hikes. They haven't even gotten to quantitative tightening yet, which is actually reducing the size of their balance sheet. So if we look at crypto, if we look at risk assets, and unfortunately right now, Bitcoin and other cryptos are trading as if they are risk assets. I'm not saying they are, especially long term, but right now they're trading that way. If you look at the NASDAQ, if you look at ARK Innovation as an example, they are down massively since the Fed just announced tapering. So again, taking Jerome Powell at his word, if they raise 3-4 times, if they even start quantitative tightening, what does that do to the stock market? And I think it's very easy to see us getting to a 1972 type of environment where the stock market, again, is going down by 50% in nominal terms, but consumer prices are increasing substantially. And then the next question becomes, what does that do to overall purchasing power, right? What was the pain index? I believe that was inflation plus the unemployment rate or something like that. Well, I think they need to get a new pain index with consumer price inflation compared to the rate of the stock market going down, because I believe that our economy today is far more dependent on the stock market than the economy was back in the early 1970s, right? Yeah. So again, it's this weird type of economic environment that Keynesians don't think can really exist, because they're looking at the Phillips curve and saying, well, if the unemployment rate is down at 3 or 4%, just forget about labor force participation. Then that means that we should see inflation. And Keynesians, they conflate inflation with economic growth. for some reason. I don't know why they do that. They think that inflation means the economy is booming. And as most of us know, that's absolutely not true. That you can have an economic contraction while you see significant consumer price inflation. So I think that's one thing where the market and the retail investor may be offsides. The other area I think is probably housing, because people think that if the housing market goes down, that it has to go down in nominal terms, right? We have to see a GFC as an example. And I always point out that that's when you adjust for inflation, that isn't necessarily true. That we have, if you look at the price to income ratios right now in the United States for housing, they're at all-time highs in a bad way, meaning that it's over 7 times the annual income to buy the average house. And that's higher than it was back in 2006. But so most people think, okay, well, then housing prices have to come back down to get to their historic trend adjusted for inflation. And that's, again, not true. You could have an environment where wages are going up by 5%, but they're lagging CPI, especially real CPI. And let's say that's at 10%. So people's purchasing power is decreasing. But then let's say housing prices are only going up at 7%. So the unaffordability is increasing, but yet the housing prices in real terms, as far as purchasing power, is actually going down. And when you look at the stock market going down, potentially with people's equity decreasing in real terms, that's when we could further see this inflationary recession. So that's not really a prediction, but I think that's something that not a lot of people are looking at, and I think they should be thinking that through.
George, thank you. You covered so much there. I know for a lot of people, it may go over their heads a little bit, but just it's clear that you believe there's a recession coming, and it's going to look different. It could more look like a 1970s event rather than just simply some sort of crash.